You can see you had this beautiful wedge pattern right here. And again, this wedge pattern, look at this trend line, how every time going back to 2023, every time it hit, it pulled back, pulled back, pulled back, pulled back, and then pulled back recently in 2025 twice. And all of a sudden it breaks out, consolidates. This is a bull flag, and it's beginning to move higher. So this is a breakout on silver. And silver, we know, has lagged gold. I do think it's playing in the process of playing catch up. Basically, I'm expecting it to have a small stop at $44 per ounce, but really likely headed to about 48 to 50, which would then, if we go to the bigger time frame, 48 to 50, where does that take us? Back to this high here, 1980 and the 2011 highs. Essentially, that would be called a triple top, and that would be expected to be resistance.
Silver's recent move has caught the attention of market watchers as the metal broke through key resistance levels on the back of strong fundamentals and shifting sentiment. According to Gareth Soloway, the breakout is not a product of speculative noise, but rather a reflection of tightening physical supply, rising industrial demand, and the growing likelihood of dovish monetary policy from the Federal Reserve. These converging factors have built a base of support that is giving silver fresh momentum and putting it firmly back into the spotlight as one of the most attractive assets in the commodities space. Soloway emphasizes that the price action is setting up a bullish trajectory with further upside potential if silver can maintain its strength. He notes that silver's dual role, as both a monetary hedge and an industrial necessity, provides a unique layer of resilience against volatility. While many commodities remain vulnerable to shifts in investor sentiment, silver is being bolstered by the structural demand of sectors like solar energy and advanced technologies, which continue to absorb more of the available supply. This industrial underpinning, paired with tightening physical availability, is helping to push valuations higher in a way that appears sustainable rather than fleeting. Looking ahead, Soloway points out that if silver extends its current momentum, the next stage could bring a decisive move into territory not seen in years, opening the door for accelerated gains. A breakout of this scale would not only validate the bullish setup, but also carry broader implications for confidence in the financial system, as precious metals once again highlight their role as a safeguard in uncertain times. For investors, silver's recent surge is more than just another market swing. It may be signaling the early stages of a much larger and lasting upward trend. Before we dive into Soloway's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Charts are looking good on silver. I continue to like silver here. You can see you had this beautiful wedge pattern right here. And again, this wedge pattern, look at this trend line, how every time going back to 2023, every time it hit, it pulled back, pulled back, pulled back, pulled back, and then pulled back recently in 2025 twice. And then what it does is it gaps above. It's like, okay, I can't walk through this river because it's the rushing river will take me away. So let me hop over. Let me take the bridge over. And all of a sudden it breaks out, consolidates. This is a bull flag, and it's beginning to move higher. So this is a breakout on silver, and silver we know has lagged gold. I do think it's playing in the process of playing catch up. Basically, I'm expecting it to have a small stop at $44 per ounce, but really likely headed to about 48 to 50, which would then, if we go to the bigger time frame, 48 to 50, where does that take us? Back to this high here, 1980 and the 2011 highs. Essentially, that would be called a triple top, and that would be expected to be resistance. So if you have silver, right, and silver, let's say, rips up to 48 to 50. Let me get my drawing tool out here. So let's say we rally up here. You then watch, as a technician, you watch to see what it does off of this level. What you want it to do is basically go sideways to lower, which creates a bull flag. It's essentially digesting. Think of a marathon runner who just ran a marathon. They're exhausted. You can't be like, go run another marathon. They're going to be like, no way. I need to refuel. I need to sleep. I need to rest. I need to eat. This is what this is. It's consolidating. It's refueling. And then you get your big move up. What you don't want to see is you don't want to see a sharp reversal. A sharp reversal would be bearish. So as a technician, if let's say we get to $48 to $50 an ounce on silver, I will then begin watching what price does around that level, and that will give me insight into the next likely move. Yeah, so I think what we're going to see here is that silver is going to be seen as obviously the macro driver of combustion engines, which are now becoming more and more popular again after the EV kind of had its phase. And I still think EVs are in that direction and they will continue to grow, but not nearly as much as people thought. And so I think you have that aspect to it. But I also think that you're looking at there's these sovereign funds in these countries that are saying, okay, gold has had this massive run, and just like the dollar, we don't want to just be in one metal. Like, what if something happens and there's a massive find of gold? Let's diversify. And I think again, what's so interesting here is that these countries are learning from their mistake with over accepting the dollar as the major reserve currency, where it gives the US way too much power. They are not comfortable with that. And now they're saying, okay, listen, gold is great, but now let's also have a little of X, Y, and Z metals in our portfolio. And I think that's a great thing. I mean, it's the equivalent of having Bitcoin, but having some Ethereum in your portfolio. Same sort of thing, or Apple and Microsoft and Google, right? We just don't go all in on one thing. And they learned from what they've done with the dollar and the power that the U.S. wielded. I would say I couldn't have written it better myself. I've gone on record for the last few years as saying that we are slowly, it's like a train wreck, a very slow train wreck of countries overspending, running up debt, and eventually the fiat system will collapse. I actually think that the Federal Reserve will be the scapegoat when all this goes through, and I think the Fed will likely be disbanded, and there'll be some new form of a Federal Reserve that's put in place. But the basis of it is that those that have physical metals, that is where the value will be held, and I think that's the key. And it's almost like a societal reset, right? I mean, you see everything going on in the world today, and it's just getting worse and worse and worse. Whether it's social media or all these other avenues, and it's going to reach a boiling point. And the U.S., along with all these other countries, they've lived off of debt, and it's unsustainable. And there will be a collapse, and it will be a financial reset. I do think what comes from the ashes of that will be amazingly good, but it's going to be the hardest time, like we talked about earlier, since the Great Depression. It will be the hardest time, hopefully not worse. I'm actually a big fan of diversifying, not just with gold, but platinum and palladium, silver to some extent as well. But what I love about platinum and palladium is that as you look at the rarity, right? So for me as a technician, I always look at the data, and we know platinum and palladium are like 30 times rarer than gold. It's just gold is the one that everyone loves because it's what jewelry is made out of. But when you start looking at fiat currencies and what's going on with the printing and printing ad nauseum of these currencies, you got to start saying, well, platinum and palladium haven't even caught up to where gold has run. Maybe that's the hidden trade here to go long. And granted, I understand with cars and the demand. I mean, a lot of why platinum moves the way it does is because of the metal that is used in cars. But also, you just have to say it is so rare. It's even rarer than gold. Maybe that's the secret place to stash a little bit of cash. And that's what I'm doing as well. I'm picking up a little bit of platinum and palladium here over the next couple months because they are way discounted to gold. Right, and by no means am I saying don't have gold. I mean, gold should be the core holding. But I do think, like, people buy Apple and Microsoft stock, and those are like your blue chips. Well, gold is your blue chip metal. But I do think there's portions of a portfolio where you could say, okay, well, 2% to platinum, 2% to palladium. And if those run up, let's say 100, 200%, but gold only goes up 25, you're really getting a little bit more bang for your buck in that scenario. Yeah, so I mean, in general, I'm a big fan of the physical, just because I wouldn't call myself a prepper, right? But I'm someone who sits.
I would call you a prepper.
Okay, fair enough. But you want to have something that you have in your hand. If when I buy gold and I buy some physical gold, and listen, I have my investments in my swing trade accounts in GLD and GDX and all these other places. But you always want to have a little of the physical, because if all of a sudden you wake up one day and the credit cards aren't working and you can't go to the bank to get money out, you need some sort of currency that has value. And I think it's just important as an investor, I look at risk. And while it may never happen, and I hope it doesn't happen, you can never be over prepared. And again, I always say to people, just, worst case, I leave it to my kids in my will, and they have a little bit of physical gold and they can just hold it for their kids. But if you have that safety, it lets you sleep better at night.
Gold has been steadily regaining ground, with recent price action showing renewed strength as investors position for potential shifts in U.S. monetary policy. Concerns over slowing global growth, combined with expectations of a more dovish Federal Reserve, have created an environment where gold's role as a safe haven asset is once again in focus. Unlike short-term speculative rallies, this move is being supported by tangible macro drivers: inflationary pressures that remain sticky, geopolitical tensions, and increasing demand from central banks seeking to diversify away from the dollar. Together, these forces are reinforcing gold's appeal as both a store of value and a hedge against financial instability. Analysts note that gold's ability to hold above key support levels signals resilience even as broader markets face volatility. Demand from Asia, particularly China and India, continues to provide a strong physical foundation, while Western investors are steadily returning to the metal as uncertainty around equities and bonds lingers. The combination of steady physical buying and rising investment flows suggests that gold's current trajectory is not a temporary spike, but rather a developing trend toward higher price consolidation.
So, I mean, and that's such a big topic right now. Is it done deliberately or is it just an oversight? And I think we have to go to the root of the problem. And again, I'm not saying that there's nothing done deliberately out there, because there certainly is. But one of the things that drives me nuts is that the government sends out these surveys to companies and they say, hey, could you please let us know, are you hiring? Are you firing? Are you doing nothing? And there's a tendency, if a company is hiring, they're quickly like, oh, yes, this is good news. Let me fill it out that we're hiring and send it back in. But if they're not, if they're firing, no one wants to write that in. Like, yeah, I had to fire 5 employees today or whatever it may be. And so because the government doesn't make it mandatory that there's a receipt of this data back to them by a certain date, there tends to be a lag on receiving this data, right? It's kind of like goes on the pile and the CEO says, oh, I'll do it when I have time. It's not great news. And I think that's one of the big problems. And it drives me nuts. If you and I get something from the IRS, they say respond by this date, and we all know, if not, you're in trouble. With this type of stuff, there's no penalty. So like a company can just take their merry old time, yet the Fed is literally basing their decisions on federal interest rates on this data, right? We're all trading. Like, as a trader, I am trading on this data. It needs to be accurate. The government needs to put a direct receipt date on it, like get this information back by X date, or there will be a fine. And I know that sounds crazy and kind of maybe a little ruthless, but when you have trillions of dollars being traded on this information, you have to have it accurate. The market's kind of rallied on hopes of a 50 basis point, but this is the tricky thing. We are now in an official stagflation environment, and really most media is not going to announce that, folks, but the definition is slower growth, and in this case, the labor market is slowing dramatically, and higher inflation. And we saw the CPI this week coming in at 0.4% on the headline, and just map that out, multiply it by 12. If that stays at 0.4 every month, we are basically at 4% inflation, if not even a little bit higher. And so that's the definition of stagflation, and that puts the Fed in a ridiculous bind. So yes, they will give you a rate cut coming next week, 25 basis points, probably one at every meeting, but the markets, in my opinion, have already priced that in. And my thing is this: I think we sell off next week. And by the way, late in the day on Friday, we saw some big accumulation in the VIX. The VIX is the fear index. It's basically below, or was below, 15, very historically low. And when I see that, it is a warning sign that institutions are starting to buy protection for expected volatility. And so ultimately, my expectation is a very hawkish Jerome Powell. Yes, he'll do the cut, but he's going to talk about how inflation is still an issue, and it's going to make the market rethink how many cuts next year they're going to get. Yeah, so I don't have a chart on that, but folks, I have seen these charts every which way, and we can definitely put one in for you. But the key is this, is that if you look historically, markets rally on rate cut expectations, the excitement of cheap money. But once the Fed starts cutting rates, historically, the markets actually go down. And the reason they go down is very simple. By the time the Fed actually starts to cut, the market is fretting that they are behind the curve once again, like the Fed usually is, and they need to cut more. But the Fed is very slow on cutting, and we're seeing that with the inflation numbers. The Fed will likely just cut one time at every meeting into year end. And so the market then starts to price in that things are a lot worse than expected and that we're heading towards a recession. A recession means lower profits and profit growth for companies, and PE ratios start to adjust. So be ready for that in this scenario. And remember, technicians like myself, we don't reinvent the wheel. We look at historically what happens every time. And if it happens every time, who are we to think this time will be different? A lot of investors out there will tell you, oh, this time's different. I heard that in 1999 too. And then we saw 85% drops in many of the big name tech stocks then as well. Point where I do think you're looking at a 20-30% correction into next year once again. And the difference here is everyone will expect it to rebound like after the Liberation Day sell-off, after the COVID sell-off, after even last in 2024, that August nasty sell-off. We came back to all-time highs. I don't believe that is going to happen. And I think, honestly, the market and maybe Fed officials and maybe government officials have done a big disservice to investors by luring them in. Since COVID, millions of new young investors have come into the market, and they now believe that the biggest correction they'll see, yeah, they might see down 20-30%, but within 3 months, we're at all-time highs. That is not always the way. In fact, if you look back at 2000, when the NASDAQ collapsed, 15 years it took for it to hit a new all-time high.
So, but you're saying a 20 to 30% pullback in equities by the end of 2025?
No, I don't necessarily know if we'll be down that much in the next 3 months. I think it's early 2026. And the kicker is this, is that, again, because the markets trade on psychology, right? So you have the human psychology of, oh, it's a 3% pullback, let's buy the dip. Okay, so then you get a 2% bounce, right? Then you get a 5% pullback, buy the dip, you get a 3% bounce. And so initially when markets top, they tend to top with a lot of chop with a slight downward angle. And then eventually people start to say, wait a minute, I keep buying the dip, and then it keeps making lower lows. And then they stop buying the dip, which is when the downside accelerates. And that's usually the bigger move. So initially, especially the way the markets have been conditioned, you'll see sideways to slightly lower chop. Then the downside comes in probably in early 2026. And we are in extreme greed to the point where, I mean, when you see Oracle, and I'm going to show you guys a few charts here that just kind of blow my mind here. So let's look at Oracle, ORCL, 40%, actually it was up as much as 40% on earnings. This company was valued at $700 billion before earnings were, it basically plummeted back down here. But when you see these type of moves where a company can gain that much, and again, by the way, you have to go back to the 90s, by the way, pre.com, the last time Oracle had a move of this magnitude. And that's very telling to me is when you start to repeat history, it makes me on high alert. But we see that Oracle's obviously coming back in. But then you have other stocks like QMMM. This stock in one day ran 2,700%. Now, all this company did was say, hey, we're going to put some crypto in our treasury, and investors rallied it 2,700% in one day. And again, you could go to many other names. Octo was another one this week. Octo rallied 5,600% in one day. And again, for those of you that have traded crypto, remember in 2020, 2021, or even prior to that, where altcoins were doing this type of massive move, and then the collapse occurred. And this, to me, is a sign of that kind of gambler's mentality that is so concerning in our markets right now. And again, just a couple other charts that I'd love to show you guys here, because I do think this brings a kind of a more grounding perspective. And one of the things I talk to everyone about is just look for the breadcrumbs. And the breadcrumbs, while it doesn't tell you like on this specific date the markets will top, it gives you enough data to make smart decisions, right? And you might feel like, oh, I missed the run up or I missed, the last leg. But you know what? Protecting, at least for me, protecting my money is the most important thing. This is the S&P price to sales ratio. We are now at over 2 standard deviations away from the average, historical average. And by the way, we are more than in 2020, and that is astounding. Then we flip over to this chart. Here's the S&P 10-year PE ratio, 2 standard deviations above. Granted, not at the internet bubble high, but incredible how overbought we are in that metric. And then lastly, this one, guys, this is the Buffett indicator, right? So we all have heard about Warren Buffett. Buffett indicator is the ratio of total value of the U.S. stock market versus the current measure of total GDP. And look, we are now at all-time highs on this metrics. You can go back to the .com level. We're above that. And basically, I mean, just to summarize, when you're 2 standard deviations above something, it doesn't tell you, again, this date, we're going to reverse this second. What it tells you is you better be freaking on point, because at some point the music is going to stop and the rug is going to get pulled. And the higher you get, usually the harder you fall.
Looking forward, gold's outlook is firmly tilted to the upside, with momentum building toward a potential breakout that could reshape the market's trajectory. A sustained move higher would not only reflect investor confidence in the metal's enduring role as a hedge, but also highlight the growing disconnect between fiat currencies and tangible stores of value. If central banks continue expanding their reserves while retail and institutional investors add exposure, gold could be propelled into a phase of price discovery that challenges long-standing resistance levels. This momentum would be further amplified if monetary easing from the Federal Reserve coincides with heightened geopolitical tensions, as both factors traditionally serve as powerful tailwinds for the metal. For investors, the implications extend beyond near-term price movements. Gold is increasingly being recognized as a strategic anchor in portfolios, offering stability at a time when traditional assets remain vulnerable to policy missteps, inflation shocks, and systemic risks. A decisive rally would reinforce gold's unique position as a safe haven asset that thrives in uncertainty, while also signaling a broader revaluation of its importance in the global financial system. In such an environment, gold's role is not simply about price appreciation, it is about preserving wealth in a world where confidence in paper-based assets can be tested at any moment. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.